Now, options, you might or might not have heard about it, I will, by the way, I see a question coming in, 80-20, not 50-50. I will address this question. It's a good question, Dan. Thank you for this question. And Zheng as well. And I will answer some questions that are coming in, but I want to finish my story and then I take these questions, okay? So the options here that I use are the best way to hedge myself, okay? So I need them to protect a company. So I want to show you just a simple little thing so that you hopefully understand what I'm talking about. Now, for instance, let's take a look at this one. Now, suppose you are interested in buying a stock. Now, I'm interested to buy, for instance, Ahold. Ahold, you probably all know, it's like Albert Heijn, it's like Bol.com. This is the company, and it's listed in the Amsterdam Stock Exchange. Now, the stock is currently at 28. Now, let's suppose that I'm interested right now to buy it. Okay, to be honest, I wait a little bit more, but I'm interested to buy it around 27 and a half. This is what I'm currently looking for. Okay, now why? Because I believe that in the next 3, 6, 9 months, this stock will probably go up anywhere in the range 32, 35. Okay, this is my expectation. Now, I want to make money based on going from 28 to 32. That's 10, 15% if I buy the stock, but I don't want to be a stock owner. I want to be stock owner plus protection in a clever way. Okay. Now, if I buy this stock and you say, oh, great company, buy the stock because Bol.com will go to the exchange and a lot of analysts are positive about it. I all hear these stories. Fine. But still, the question is, what is it when the stock is not going the way I want it? So how do I protect myself? You can buy an insurance and it's called a put option. Okay. A put option. Put it over there. It means that you can put your stocks in the hands of somebody else. So you buy the right to sell your stock at a certain level. For instance, 26. And you want to have this right for 1 year. Now, so you buy a stock at 28. You buy an insurance at 26. You have this insurance for 1 year. And whatever happens to the stock, whatever happens to the company, whether they go bankrupt or not in this year, you are protected. You will always get 26 euro a share. And since you bought it at 28, your risk per share is 2 euro. Okay. However, I can tell you that the premium you have to pay to protect these shares for 1 year is actually this afternoon, it was at 1.75 a share. So you pay 1.75 for a 1 year protection on your stock. Now you have to remember, if you have 100 stocks, you need one put, okay? Because each put is about 100 shares. So if you buy 100 shares, you need one put to protect. Now let's say we would do that. So you buy at 28, you have a strike price of protection at 26, that's your insurance. So you your risk is 2 euros a share, okay? Now, there's one good news that as a shareholder, you will receive dividend, okay? The company makes money, and who belongs this money to, this profit, is of course for the shareholders. So a large part of the profits are being paid to the shareholders, which in this case is around 1 euro a share. So around 1 euro, this is the expectation for the next year, for the coming year. Now, if I pay 1.75 for the protection, but if I get 1 euro per share, that means my protection is only 75 cents. Okay, so I say, okay, this 1 euro I use for paying this 1.75. So my protection now costs 75 cents. Now what happens now? I get a risk of 2 plus the 75 cents, which is 2.75. This is the maximum that I can lose for the next year in this investment. So I buy at 28, my protection is at 26, gives me 2 euros risk.
Order filled.
I need to pay 1.75. But I will receive 1 euro in dividends. So that means, in this case, that my risk is only 75 cents. So at 25.25 is basically where my actual protection is. So I buy at 28, 25.25 is my protection. I can always sell at 26, but I pay the premium of 75 cents. Now, the good news now is, if I'm right, and the market goes to 32 in the next coming months, that would mean that 28.32 means a $4 euro return. 4 euros. However, I paid 175 for my insurance, so I only have 2.25, okay, as a profit. But I also receive 1 for, in this case, dividends. So I have 3.25 upside. Now, if I make 3.25 on this investment, and the actual investment is a little less than 30, 28 plus 175 is 29.75 is my investment. And if I make 3.25, that's more than 10%. Now, if I make 10% in the next 6 to 9 months, I thank you very much. I bow. I drink a nice cup of Chinese jasmine tea, or even better, French wine. And then I say, okay, thank you very much, up to the next deal. Okay? So I see this as a deal, and I want to make some profit on this. But I'm always protected. So can I be wrong? Yes, of course. The market can go down. The stock could go back to 22, where it was a year ago. Is that possible? Rule number 1, everything is possible. And I don't know. So yes, that's possible. It's not my expectations. It's not where I put my money, because I believe that there is some upside here, and I want to be involved. Okay? Now, this is really the basic idea about it. My strategy, to be honest, is a bit more complicated than this. Okay? Because now I'm going to do something completely different with you, and something, how you say that, dangerous with you. Nothing happens, but I'm going to do something dangerous, because I'm going to explain to you that I never buy this stock. And you say, yeah, come on, you tell me buy the stock and buy the insurance, and now you're going to tell me leave the stock alone and buy something else. Now, what I do, instead of buying a stock, I buy a call option instead. Now, what I want to do is to show you what kind of call option I would buy. Now, again, this is a bit dangerous for me, because I might lose you now in this story, okay? It's a bit complicated, but I try to do my best to explain to you, okay? Now, I have to show you this overview. We just talked about a put option. Now, a put option, if I buy a put option, it gives me the right to sell my stock. This is what we just did, okay? We had the share, we had the stock, 28. We bought a put at 26, so I have the right to sell at 26. This was the put option. But if I have the right to sell, of course, my counterpart is somebody who has the obligation to buy. This is my opponent, okay? I pay the premium, my opponent receives the premium. This is how it works. Now, forget this part, okay? Put this aside for a moment. We just tackled this one. We were talking about buying a put. Now I tell you, I am interested to buy a call. Now, calling is shouting, is asking for something. You want to have the right to call, the right to buy, to call your stocks if you want to. Again, I'm not interested in buying these stocks, because I believe, and I can show you, that it's far, far, far better to buy a long-term call option instead of the stock. Instead of buying 100 stocks, I buy one call, okay? And I buy it with a longer term expiration. So I buy it for a couple of years. So I buy a right that lasts for a couple of years. Now I will show you the amount that you need to pay this afternoon. And for instance, there's the longest running call option in the market this afternoon was December 2026. Now you think, okay, December 2026. What is it that you want, Andre? What I want to do is to show you that the premium in the market this afternoon was anything around 9 euros to pay for a call 20. Call 20. If I buy a call with an exercise of 20 and the market is at 28, I hope you understand that the intrinsic value of my right is 8, because I can buy at 20, but the market is already at 28. Now, if I ask somebody, are you willing to give me this right? My opponent will say, hey, listen, I'm not stupid. If you want to have the right to buy at 20 and the market is already at 28, then this right is already 8 euros intrinsic value. So at least you have to pay me 8 euros. I hope you understand that. But I want to have this right for the next couple of years. So until the end of 2026. So it's a long-term option. I have to pay a premium. So my opponent will ask a premium for this. And actually, the price I had to pay was around €9. So basically, I pay €1 extra for the right to wait to think about exercising my option for the next couple of 4 or 5 years. Okay, so I have the right to buy at 20. It's already worth 8, so I pay him the 8, but actually I pay him a premium for this the right that I have it for 4 or 5 more years. Now, stick with me. We do one little exercise. What would happen if the stock would go to 0 next year? Coming years, coming months, there's a big fraud. Stock market is going down. Ahold is going bankrupt. The stock is worth 0. What happens if I would have bought my stock? Well, the stock was at 28 when I bought it, and when it's go to 0, I lose 28. I hope you're with me. If I, instead of buying 100 shares, I buy one call, I buy the call 20 for €9, what can happen? But basically what can happen is that I lose my option because the stock is not existing anymore. My option has no value anymore. So I lose my €9. Okay, I lose €9. That's the worst thing that can happen. I won't exercise my right. I will not buy at 20, okay, because the stock is at 0, but I lose my premium. I lose my €9, okay, and I will lose them in the next 5 years, okay. So this is the worst thing that can happen to me, is that I lose my intrinsic value for the next 5 years, and I have time. I have time to exercise my right. But instead of losing 28, running the risk of losing 28, I now have the risk of losing 9. Now, what sounds better to you? Losing 9 or losing 28? I hope you're with me. Okay. Now, what happens if the stock is going up from 28 to 56 in 5 years? So incredible run. The stock owner will say, that's great. I have 28, I bought at 28, now it's at 56, I made 100%. My investment doubled. Correct? And in the meantime, don't forget that, in the meantime, he will receive probably a €1 dividend. I, as an option holder, as a call option owner, I have the right to buy the stock. I have not the obligation to buy. I have the right to exercise mine. Will I exercise my right if the market is at 56? For sure. Why? I have the right to buy at 20. If the market is at 56, this right is €36 intrinsic value. So that's a good deal. I bought it at 9 and I can sell it at 36. That sounds interesting. That means a €27 profit. What did my colleague did? He bought 28 the stock and sold it at 56. He made 28. What did I do? I made 27. Okay? It's not a fair comparison. Why not? He makes 28 plus, in 4 years' time, probably also 4 times €1 in dividend. So, okay, he makes 28 plus 4 is like 32. So I have Mr. 1, which is in this case 28 plus 4 dividend, it's 32. And Mr. B, this is Mr. Brouwers, this is me, I made 27. Now, I already told you, it's a rocket. If you own the shares and they go up, 28 is your profit. If they go down, 28 is your risk. What I did, I changed my game and I say, if I go down, I lose 9. If I go up, I made 27. Okay, I hope you understand what I'm doing here. This might sound too good to be true. Okay, and you know what they say. If it sounds too good to be true, there must be some in it. Okay, but if you understand what I'm trying to do here now my next step is the following. Okay, I told you it's a bit risky what I'm trying to do here because I don't see your eyes. I have no clue whether you're with me or not, but I continue, okay? So instead of buying a stock at 28, I do the following. I buy one call. So instead of 100 shares, I buy one call. One call is the equivalent of 100 shares, okay? If I buy one call for €9, it's times 100, which is €900. So I have to pay €900 premium to have this right. And I can stick to this right for the next 5 years until the end of December 2026. Okay, this is my right. This is what I just bought. The good news is, if I go down, I cannot lose more than 9. Now, if I go down, not to 0, but maybe to 22, what will happen? Now, 28, 22, the stock owner will lose 6. But I can tell you that I won't lose 6. I will lose probably something like 3, only half of it. Why? Because I have bought a parachute, and the call option will still be there this year because it will run until the end of 2026. So this option will still have a premium. Okay, and you can see that because if you look at, for instance, the premium that you now today had to pay for an option based on 40, for instance, the stock was at 28. You can see the stock price here this afternoon. If you take a look on a call 40, it was still 140. So that means even if it's €12 away, it still has a premium. Why? Because it's still not December 2026. So what will happen is if the market drops over the next 3, 6, 9 months, I will drop with my investment, but I will have a parachute because I cannot lose more than 9, and I will not lose 9 because I will have my right until December 2026. So we'll probably, instead of losing 9, I will probably lose, instead of losing 6, I will probably lose only 3. So I cut my risk in half by buying this call. This is the smart way. If you understand this concept, you will never buy stocks again. Okay, I tell you. So I buy this call, and this is my parachute. Now, I already told you that if you buy the stocks, you buy a put, this fire insurance, you remember? If the stock is going down, I bought my put to protect my value. And I told you below 26, it will increase value, the put option. Now, the stupid thing that I do, you might find it stupid, is I buy one call, but I also buy one put. Now it's getting complex. For sure, I will lose you now. Okay? Cannot be that you understand this concept in 10 minutes. I mean, I admire Chinese and the intellect, but if you're still with me, that's great. Okay? If you lost me, don't worry. We need to go over this a couple of times before you really understand. Still with you then. Okay, Vivian, still with me. Very good. How can I buy a call? I will show you later. So much to teach you. There's a lot going on. Always with you. Very good. So we have these smart people, like Gabby told me. That's fine. Okay, here we go. Now try to understand what we're doing. So I have my call. This is my parachute. If the market goes down, my call will go down. Of course, it will lose value, but it will be sticky. But there will still be premium because I have the right for the next couple of years. That's fine. On the other hand, I bought a put. Now, if the stock is going down, I told you the put will insure you and will go up in value. Your fire insurance is worth something if your house burns down and you have the premium, this certificate of the fire insurance. This is worth money. Once the stock goes down, the put option will increase in value. Now, what will happen is, and this is really great concept. If the stock is going down, your parachute will protect yourself, but you still lose money. Okay, you will not make money, you will lose money, but not as much as the stock owner. On the other hand, if I buy a put for 1.75 for the next year, if something in the next 3, 6, 9 months happens and the stock goes down, my put option will increase. Now, hopefully you understand that it could happen that if in the next 6 months the stock would go down from 28 to 0, just try to think about that. Disaster. I will lose 9 because it's end of the story. The company does not exist anymore. I will lose 9. I cannot lose more than my call option. I lose 9. But the put option, I have the right to sell at 26. If the stock is at 0, what is the put option worth? I can sell at 26 and it's at 0. This means the put option is worth 26. I only paid 1.75. That means I make a killing. 24.25 is my profit in my put. So the put overcompensates what I lose in my call. Got me? I lose 9, but I make 24.25. That's crazy. Now, the stock owner, he lost 28. His complete investment is gone. What happens with me is I lose in my call, I will make a little bit in my put, I lose in my call, I make more in my put, I lose more in my call, I make even more in my put. So what happens is at a certain moment when the stock is dropping, I overcompensate. So I first lose money, then I will compensate more, then I don't lose anymore. And if the stock drops further, what I will do, I will overcompensate. Okay? Now, if you catch this, I'm more than happy now, because I managed to give you an idea of what we're going to do with regards to my strategy. Again, it's not rocket science, but if you hear this in first instance, it might sound different and difficult. Now, different is definitely, but difficult must be. Okay, it's not an easy one. But I hope to give you a bit of a taste of what I'm trying to do. Okay, this is not a complete story because there is more to it. And how do you select the call? Where can I buy it, Andre? Why is it that you buy at 20? Why is it that you buy December 2026? Why is it that you buy a put? Which put do you buy? How do you combine them? Why is that? But still, if I buy both, I lose my premium. How can I compensate this premium? Oh, I will tell you. I will teach you. These are all questions, okay? I know that this will take, even if you're a clever one, this will take a couple of sessions to understand this whole concept, okay? Now, theory is one thing, but you need to see this also in real life. You need to see this when the markets are moving. Oh, suddenly the stock drops. Hey, what happens with my call? Oh, I compensate with my put. That's what Andre told me. Yes, of course you're going to compensate. So I will show you in real time so that not only you see the concept, the theory, but you also can exercise the theory into practice. Now, I tell you one thing. Don't try this at home, okay? Don't do this. Don't even think about touching it if you have no clue what you're talking about here, okay? Really, do me a favor. I mean, I'm willing to share my ideas. I'm willing to teach you, okay? This is all fine. But please be careful, because you can only lose your money once, okay? So if you're going to do things that you don't understand, don't do it. Okay, if you think this is not for you, I'm all fine. If you think this is too complicated, I'm all fine. If you do have an idea, what I'm telling you is a good solution for your money to protect your wealth, to make this 8% on a yearly basis, then I'm all fine. Okay, I'm willing to help you. Okay, I'm willing to help motivated people. It gives me a good feeling if I share my knowledge. This is what I did tonight. I had 1 hour, 1:30, so we're almost there. But I'm willing to take your questions. I'm willing to share more information, maybe going real life. But this is basically what I'm telling you. So I hope you have an idea why I do it. Why I do it? Because I saw people in the 90s and the 2000s going down with the stock market. They lost 62, they lost 58. Okay, they lost a lot of money and it takes a lot of time. And I don't want that. It's not necessary. If you do it in a clever way, there are other strategies. And I think now, more than ever, after 10, 12 years of bull market, it's time that you realize that there is an alternative to what a lot of people are telling you. This is what I wanted to share with you. And I thank you for your attendance and thank you for your remarks in the meantime.